Chapter 10 gets us to my favorite topic, derivatives. A derivative security is just what the name implies. Its value is derived from some underlying asset or market condition. In most cases, the two parties agree to a standard quantity of some asset, a predetermined price, and a specific future date for the exchange to take place. The payoff on a derivative is linked to another security. The focus is on transferring risk. Derivatives should have a neutral impact on the economy, since those who want to take on risk can, those who want to avoid risk can transfer it. In 2003, Alan Greenspan, former Federal Reserve Board Chairman, credited the derivative securities markets with helping the banking system maintain its strength through the economic recession in the early 2000s. One of the attractions of derivatives is that they're leveraged, meaning investors can put up a small amount of upfront money to control a much larger position. Derivatives can be used for hedging or speculating. Speculators are strictly using the leverage factor to bet on price movements. The so-called leverage factor, the ratio of the rate of return on a derivatives contract divided by the rate of return on the underlying spot position, and it can be as high as 60 or 70 on many derivatives. Hedgers are seeking to reduce the risk in a position they already hold. The first wave of modern derivatives were foreign currency futures. They were introduced by the International Monetary Market after the Smithsonian Agreements of 1971 and 1973. Interest rate futures formed the second wave, introduced by the CBOT, driven by the increase in interest rate volatility in the 1970s as a way to hedge interest rate risk. And the third wave, credit derivatives, in the 1990s. These are more complicated and include credit forwards, credit risk options, and credit swaps. Getting back to the basics of derivatives, let's look at three types of contracts. A spot contract is an agreement to exchange assets and payment immediately, and as we've mentioned, immediate in the spot market can mean 2 to 3 days. A forward contract is not standardized. It's customized to the needs of the two counterparties. There are no standard terms on a forward contract. These are not traded, so they are risky. Either counterparty could default. A futures contract is standardized and exchange traded. Futures differ from forwards in some important ways. Futures are marketable, meaning if you want to get out of a position, just reverse it. If you bought a contract, sell it, and vice versa. There's no default risk, which we'll explain on coming slides. Two features that help ensure against default are the margin requirements and the process of marking to market every day, and we'll cover both of these with examples. Futures contracts have traditionally been traded via open outcry, and we'll see a picture of a trading floor on a coming slide. There's several different categories of traders on the floor. Floor brokers execute trades for the public. Professional traders are trading for their own account, meaning this is their job. This is how they make a living. Position traders literally take a position based on their expectations about future price moves. Day traders are speed traders. They take very short-term positions, hoping to profit on a fast price change. Their goal is to go home flat every night, selling out anything they bought before the close of trading. And finally, scalpers, much like day traders, are attempting to profit on very fast turnaround on price moves. Futures contracts are designed and offered by the exchanges based on basic marketing concepts. What do investors want? There's been a lot of merger pressure resulting in the creation of the CME Group, which combined the Chicago Mercantile Exchange, the Chicago Board of Trade, the New York Mercantile Exchange, and COMEX. Electronic trading is becoming more dominant, with the Intercontinental Exchange only electronic. This is a picture of the trading pits at the CBOT in Chicago. The pits are tiered. Different products are traded in different pits. Another aerial view of the trading floor. Note that all four walls display current prices, so they're visible from any direction. These tables detail the contract terms for a futures contract, and we'll talk about a few of these in more depth. Besides knowing what the asset is, you need to know the trading unit. If it's a commodity, it could be 1,000 bushels, 5,000 pounds. If it's a financial, $1,000, $5,000. Deliverable grades usually applies to commodities. For example, cocoa has 3 grades. Grade C is deliverable at par, the quoted price. Grade B at an $80 premium per ton. Grade A at a $160 premium. Contract months are set in series. For For physical, especially agricultural commodities, they're based on harvest times. For cocoa, the series is March, May, July, September, and December. The delivery method. For financial assets, this may be delivery of the certificate or book entry. For physical commodities, this may specify exactly where delivery can be made. For cocoa, delivery may be made at licensed warehouses in New York, Delaware, Hampton Roads, Albany, and Baltimore. As with just about all trading, a long position is a purchase, a short is a sale. With exchange-traded futures, there is virtually no default risk. This is because the clearinghouse guarantees all trades. Once a trade is recorded and cleared, meaning matched, the clearinghouse stands as the buyer to every seller, the seller to every buyer, meaning the actual buyer and seller of a contract are no longer linked. Open interest records the total number of contracts outstanding on any day, showing how active the market is in a specific contract. Futures contracts do require margin, initial and maintenance. The amount varies based on the type of contract, the quantity, and basically whether the trader is a hedger or a speculator. Minimums are set by each exchange. Initial margin has to be paid at the time the contract is entered. Maintenance margin is the level the trader must maintain during the life of the contract. If the maintenance margin level in an account falls below the minimum, then the trader will get a margin call and have to either deposit funds to bring it back up to the initial level, or the position will be closed. Table 10.2. This details the characteristics of some of the more actively traded futures contracts. Note the difference in contract sizes and how active the Eurodollar contract is based on the open interest and more actively traded contracts. The different contract sizes are not something we would all know or need to know. If you focused on trading specific contracts, you'd know the sizes by heart. Here is a futures contract quote. The contract is for a 30-year Treasury bond traded on the CBOT with delivery months of March, June, September, and December. The contract size is $100,000. Deliverable bonds include Treasury bonds that do not mature for at least 15 years and no more than 25 years. The contract calls for delivery of bonds with a 6% yield, and a price adjustment is made if they are not 6% yield. There's a concept called cheapest to deliver, which allows a variety of long-term bonds to be delivered against this contract. It significantly increases liquidity. Initial margin at this time was $2,530, maintenance margin $2,300. An investor who buys this contract or goes long is agreeing to buy a $100,000 face value Treasury bond at the original price when the contract expires. Going short is agreeing to deliver a $100,000 bond at the expiration. Each investor has to put up initial margin of $2,530, and each investor must maintain the minimum maintenance margin of $2,300. The futures price is effectively updated with the daily marking to market. Marking to market is a daily adjustment of futures trading accounts based on the closing or settlement price in the market each day. If an account balance falls below the minimum maintenance margin level, then the investor gets a margin call. This is designed to discourage defaults, since it keeps an account from getting too far out of the money. Here's a margin example. Molly believes gold prices are going to increase, so she takes a long position in gold futures when the price is $1,300 per ounce. Her broker requires $1,000 in initial margin and maintenance margin of $750. This is a lot less than it would really be. Molly deposits $1,000 into her account, and on the following slide we'll see how this plays out. Day 0. Molly deposits $1,000, so she's $250 above the maintenance level. Molly buys at the closing price. Day 2. The closing price drops to $12.98. Since the contract size is 100 ounces, a $2 change is $200. Her account drops to $800. She's still okay. Day 3, the price drops again to $12.94, a $400 change. Her account is now at $400, well below the maintenance level. She receives a margin call. She needs to deposit funds to bring the account back to the initial level. Day 4, she deposits $600 to get her account back to the initial margin level. This chart shows the variety of futures contracts available: interest rate futures, currency futures, and index futures. The other main form of derivatives is options. They come in two forms, calls and puts. A call option gives the buyer the right, but not the obligation, to buy the underlying security at the exercise price on or up to a specified date. A put option gives the buyer the right, but not the obligation, to sell the underlying security at the exercise price on or up to a specified date. Options are what are termed zero-sum game, meaning the profit to one side is exactly matched by the loss to the other side. A call option buyer has unlimited upside, limited downside. The call writer has an unlimited downside, limited upside. This looks at the payoff to puts. Puts are not the exact opposite of calls. With a call, the buyer wants the price of the underlying to go up. The seller wants the price to drop or at least stay where it is. The payoff, positive or negative, to both the buyer and seller are unlimited, since the stock price can go way up. With a put, the buyer expects or may fear the price will decline. The seller hopes the price stays where it is or goes up. Payoffs to both puts, buyers, and writers are limited, since the stock price can't drop below zero. Calls are much more actively traded than puts, so we're not going to focus on puts in this class. The Black-Scholes option pricing model is the most widely used approach to valuing stock options. The variables used are S, the current price per share of the underlying asset, X, the exercise price of the option, T, the time to maturity expressed in years, sigma, this is the price volatility of the underlying asset, and the risk-free rate. And we're going to go through this in detail at the end of this chapter. Before diving into the Black-Scholes option pricing model, let's look at the intrinsic value of an option. For a call option, the intrinsic value is the maximum of the stock price minus the exercise price, or zero. That zero, that's what limits the downside. For a put option, the intrinsic value is the maximum of the exercise price minus the stock price, or zero. Again, the zero limits the downside. An option is considered in the money if the intrinsic value is greater than zero, meaning it would have a positive value if it were exercised right now. Out of the money is the opposite, no value right now. This illustrates the time value effect of a call option. Suppose you have a call option on a stock with an exercise price of $50 expiring in 3 months. Stock's currently trading at $60, so the intrinsic value is $10. The option is currently trading for $12.50, so the time value is $2.50. If you exercise today, you gain the intrinsic value, but you lose the time value. Let's walk through option quotes. The May call option is in the money. The call premium or price is $3.30 per share. Option contracts are for 100 shares, so the cost would be $330. The intrinsic value of the call is $8.79 minus $6 times 100, $279. The time value is the $330 call price minus the intrinsic value, $51. The May put is out of the money, but the put has time value of 45 cents per share, or $45. An investor would not exercise the May call because that would be throwing away the $51 time value. Options were first exchange traded on the CDOT in 1973. Options on futures started trading in 1982. American options can be exercised anytime up to expiration. Most stock options are American. European options can only be exercised on their expiration date. Many index options are European. This table details what type of options are traded where. Stock options and stock index options, very popular for hedging or betting on the overall market. Continuing the previous table, interest rate options are widely used to hedge interest rate risk. Currency options are used to hedge foreign exchange exposure. Stock options were the first option traded and the most basic. The underlying asset is a share of publicly traded common stock. The underlying asset on a stock index option is the index. On a futures option, the underlying is a futures contract, and these have gained in popularity. Credit spread options are a bit complicated. The value of the option increases as the default premium or yield spread between a benchmark bond increases above some exercise spread. Got that? A digital default option pays a stated amount in the event of a loan default. Our last type of derivative, swaps. Swaps are an agreement between two counterparties to exchange assets or a series of cash flows for a specified period of time at a specified interval. A plain vanilla interest rate swap exchanges fixed interest payments for floating payments. The swap buyer makes periodic fixed payments on what is called a notional amount. The seller makes floating rate payments on the same notional amount. No principal ever changes hands. A currency swap is the periodic exchange of one currency for another between two parties. These are usually involved with borrowing money. The interest can be fixed or floating as negotiated, but the exchanges do occur at known exchange rates. These are used to hedge exchange rate risk from having the currencies of assets and liabilities mismatched. This is figure 1015 in your text. Suppose a U.S. financial institution has all of its fixed-rate assets in U.S. dollars. It's financing its $200 million portfolio with a £100 million sterling issue of 5-year pound notes, 6% fixed annual coupon. A financial institution in the United Kingdom has all of its £100 million assets in pounds. It is funding those assets with a $200 million issue of 5-year U.S.-denominated notes with a fixed annual coupon of 6%. Assume the exchange rate is fixed at $2 to the pound sterling. Both financial institutions are exposed to currency exchange risk. They can hedge their exposure by entering into the swap shown in this figure. In this way, each financial institution converts their liabilities into the currency in which it is denominated. Credit default swaps. These are designed to allow financial institutions to hedge credit risk. A CDS buyer is buying insurance on a loan or bond. The CDS seller receives periodic payments from the buyer. If the bond defaults, the seller pays the par value to the buyer. Credit default swaps gained a lot of attention during the financial crisis. Some of the major sellers of CDSs that insured mortgage-backed securities did not have the capital to pay up when they defaulted. Swaps are not standardized. Financial institutions are the primary swap dealers. They match counterparties to keep the market liquid. There is an International Swaps and Derivative Association that sets codes of standards. As the slide states, financial institutions use options on interest rates to hedge interest rate risk. A cap is a call option with multiple exercise dates. A floor is a put again with multiple dates. A collar is a position involving a cap and a floor, taken simultaneously. Usually that means buying a cap, selling a floor. Looking at the overall market for futures and options from 1999 to March 2016. Interest rate futures are clearly the major portion of the market, as is North America. With options, interest rates in North America are again the leaders. Futures markets are regulated by the Commodity Futures Trading Commission. The CFTC regulates futures and options on futures. The SEC remains the overall regulator of stock and stock option markets. Until Dodd-Frank, neither the CFTC nor the SEC regulated over-the-counter derivatives like swaps. Under the new laws, OTC derivatives may be required to trade on exchanges and would then come under the oversight of the SEC. Bank regulators are expected to more tightly regulate bank usage of derivatives. This is in addition to Chapter 10 covering the Black-Scholes option pricing model. As already mentioned, the Black-Scholes model is the most widely used option pricing model, and we looked at the variables before, but here they are again. Stock price, exercise price, time to maturity, volatility of the underlying asset, the risk-free rate. The Black-Scholes model is sometimes referred to as the Black-Scholes-Merton model to acknowledge contributions by Robert Merton. It was published in 1973, interesting since options began trading on an exchange that year. The author's research was actually focused on pricing warrants, those bond sweeteners that are similar to options. Scholes and Merton won the Nobel Prize in Economics in 1997. Fisher-Black had died in 1995. The Black-Scholes option pricing model values European options on non-dividend paying stock. The European part is important since these can only be exercised at expiration, making the valuation easier. But there are extensions to the model to accommodate American options and dividends. Looking again at the variables used in the formula. The first two are the solution variables, what we're solving for. C is the call option value, P is the put option value. We looked at these input variables on a previous slide. Note that the volatility is of the price of the underlying stock. These are the functions used in the formula. ln of x, read as the natural log of x, denotes the natural logarithm of the value of x. E is the base of the natural log. ND, read as n of d, denotes the standard normal probability of the value of d. The natural exponent and natural logs are keys on most financial and statistical calculators. Finding ND requires either tables or Excel. Note that the volatility is of the price of the underlying stock. The equations above may look intimidating. They really only require careful computation and substitution. Manual calculation is not difficult, as we'll see on the following slides, but there are many software packages available to perform the calculations, and it can easily be programmed in Excel as well. As noted, the Black-Scholes model assumes no dividends over the life of the option and is only applicable to European-style options. E to the x, read as e raised to the x power, denotes the natural exponent of the variable x. In this case, the power is the negative product of the risk-free rate and the time to maturity. This is a discount factor. So far, we've mostly used discrete discounting. X divided by 1 plus r raised to the t power. X times e to the minus rt is continuous discounting. E is on your TI Business Analyst 2 Plus. It's the second function of the LN key, and there is an Excel function for it. The natural log of s divided by x is considered the moneyness function. Excel has an LN function. The TI Business Analyst 2 has a key. It's to the left of the 7. ND1, read as N of D sub 1, denotes the standard normal probability of the value of D1. The use of N minus D1 is really only used in the put formula. ND is not a function available in your calculator, but there is an Excel function to find it, or you could use the normal distribution tables and interpolate. Note that there are two normal Excel functions. Norm SDIST designated the standard normal function, where the mean is 0, the variance is 1. Norm DIST, without the S, is the normal distribution which requires that the mean and variance be specified. So let's walk through an example. Suppose you're given the data shown on the slide. The stock underlying the option is currently trading at $44 a share. The option has an exercise price of $45. The option expires in 3 months, or 0.25 years. Volatility of the stock's price is 50%. This is the standard deviation. Risk-free rate is 2%. We have everything we need to find the value of a call or a put. Step 1. We need to calculate D1 and D2. The formula for D1 is shown. Be careful. A lot of mistakes happen right here. Substituting in, we find D1 is equal to 0.0551. The formula for D2 is also shown, and it yields a D2 value of minus 0.1949. Plugging those D values into norm SDIST, we find the ND values. This also shows the calculation of N minus D. Plugging all the calculated given values in the formula. The stock price, ND1, exercise price, E raised to the minus RT, ND2. Combine all those components, you get a call price of $4.0385. And here are the calculations in Excel, which is posted in Blackboard. Notice how I have calculated each element separately. 2 reasons. First, it gives you a trail to follow to make sure you're getting the right values. Second, anytime you're dealing with this complex a formula, it's better to break it into parts and then combine them. It's a lot less potential for error. And this ends Chapter 10.